All right, I'm Michael Hartzman. Today is Tuesday, September 9th, 2025, and I'm on as always with my partner Dominick Tavella, both of us on Long Island this evening. How are you, Dom?
A couple of weeks in a row, Mike, doing well. Still on Long Island. We'll see how long that lasts, but here doing well and happy to see you, Mike.
Yep. Same here. It's been an interesting couple of weeks, Dom. I mean, it appears that last week when some of the economic data came out, we were wondering whether good news would be bad news or bad news would be good news. In the morning, it looked like bad news was going to be good news because it would give the Fed the incentive to lower rates. And then a couple hours in, it was like, wait, bad news might actually be bad news because maybe the Feds have to be a little more aggressive than we anticipated. We had some weak job numbers. Overall, the market's been a little choppy. So I'm happy for our guest this evening, Phil Blancato. But that's my take on it, Dom. And I'm kind of happy about it. Bad news should be bad news. We shouldn't twist those things around.
Yeah, you actually brought this up last Tuesday, Mike. That is the bad news going to be good news, or is the bad news going to be bad news? I.e., and we did get a pretty ugly employment number on Friday. I think 22,000 jobs when the market was expecting what 70, 80,000
Mhm.
jobs. So quite disappointing. And then we got a really horrible revision on the employment numbers today. So it really now, we've been talking about it for a long time, Mike. It really looks like the economy is starting to show that both on the job creation side and the job loss side, we're having some issues coming up, right? The economy definitively is slowing down, which is not really a surprise. But the fact that the markets basically today hit an all-time high, all three major indices hit an all-time high, has clients and us wondering what's going on here. If the economy is not growing all that much, if the employment numbers aren't that great, inflation still hasn't softened anywhere near what the Fed wants it to be, why does the market keep going higher?
We will get to that, but I don't want to leave your revision point. That headline came out this morning. I was in a meeting at the Garden City Hotel with some other portfolio managers, and I had your voice in my head, literally had your voice in my head when I read that 900,000 jobs magically disappeared.
Disappeared.
How does that happen?
And, well, I wish I knew, Mike. And we've spoken to some pretty bright, intelligent guests who are like, how does this happen? How can they be off by this much? And boy, I will throw our friend Phil right under the bus with maybe that as the first question. How can they be this far off? But more important, in today's world of technology and sophistication and social media, how can they be off this many jobs? We did create them or we didn't create them? What's the real deal here? But look, at the end of the day, we'll say we expected revisions. We didn't expect this kind of number, Mike. We thought there would be revision with lower job creation numbers, but we didn't think it was going to be this one. And the period they're covering, some of it is under this administration, some of it was under the prior administration. But wait till the finger pointing starts, Mike. Whose fault is it that these jobs somehow magically disappeared? And where are the new jobs that we were promised? And what sectors of the market are we going to get these new jobs?
And I heard you said, we weren't expecting this, but my response would be, why not? If 800,000 jobs disappeared last year, why would we be surprised if 900,000 jobs vanished this time?
Yeah, I think, Mike. Again, we've spoken about this at length, but they get these numbers get revised all the time. And
All the
generally
time.
speaking, we see job losses that, i.e., the numbers aren't quite as large. Job creation numbers aren't quite as large as they first are announced. But this is a big number, Mike. 900,000 jobs theoretically are gone. I don't know if they were ever there in the first place, to be honest with you. Remember, these are surveys and estimates and blah. But boy, oh boy, my first issue is they could be a little bit more sophisticated in the process. And then you got to wonder and I think this is the real issue. Any data points now that we are getting, can we actually believe them? And I think that's way more an issue in that, hey, we created jobs, we didn't. The employment numbers, are they real? I think the fact that we're all questioning these numbers today is a bigger deal than just what the headline number is.
Yeah, and you made a point just now about the market reaching an all-time high, which I think is the 25th time this year after about 54 times last year. And that's, with a headline also I saw this morning where Jamie Dimon, the chairman of JP Morgan and a legend in our business, basically said the economy is weakening. And whether you believe that the number in the jobs report, that's the trend, that things are getting progressively worse. So it is a great question for Phil Blancato, who's at a higher pay grade than you and I are. Why does the market keep going up in the wake of bad news? Is it just the anticipation of lower interest rates? Is that the only catalyst?
And again, I really want to get into a deep dive on this one with Phil. But I think that's a big catalyst, right? In that, hey, we all know the economy is slowing down, job growth is slowing down. But if the Fed gets into easing mode, we spoke to a portfolio manager today whose firm thinks we could see three cuts this year, a quarter of a point each month, September, October, November, or maybe one in December, who knows? But three cuts. And the overall loosening policy going into the end of this year and then continuing next year would reinvigorate the economy, would add stimulus back in the economy. And yeah, we are kind of bottoming out now, but looking forward, we could see a reaccelerating economy, job growth, economic growth, better earnings. So right now, I think the market is putting all its faith on what the Fed is going to do, and hope to God it doesn't disappoint us and the markets.
And the other point or cloud that's hanging over the market, and Scott Bessent, the Treasury Secretary, said that if the Supreme Court goes through with the ruling from the lower court that these tariffs actually are illegal, and the government has to pay back $1 trillion, and no one says a trillion better than you, right? But if the government has to give back $1 trillion, how is that not kind of a hangover on the market and the economy?
Well, what first quick point is it was headline on the weekend news shows, but it's not headline today, right? Or yesterday. And you would think, my God, this should be an important issue because you got to believe this administration has a plan A, B, and C just in case the Supreme Court shoots them down, right? They'll figure out a backdoor way to impose these tariffs. But the money they've already collected, which by some estimates is between 300 and 400 billion dollars so far. And by the time this gets decided, it could be at that trillion number that you're talking about, Mike. So where are they going to get 300 400 billion dollars to give back to the companies that they've collected this money from? And that puts additional pressure on the bond market, the treasury market, interest rates. You would think this would be top of the headline news today. Nothing. Crickets, Mike. Crickets on this subject.
So
I think
listen,
it's a big deal. I'm with you on this one.
yeah. So look, enough about you and I going on and on and on about it. Let's take a break, and when we come back, we say it every week, and every week it's true, but really, Phil Blancato, I happen to know, is one of your closest friends and a great friend of the show. And I've got to know him over the last 15 years. We love having him on. He's super smart. He's a president of CEO and CEO of Ladenburg Asset Management. And I can't wait to get his 2 cents on some of the things we just discussed.
Looking forward to that.
So we'll be right back with Phil Blancato, president and CEO of Ladenburg Asset Management. All right, I'm Michael Hartzman, back with my partner, as always, Dominick Tavella, and our guest this evening, Phil Blancato, the president and CEO of Ladenburg Asset Management. How you doing, Phil?
I'm well. How are you doing?
We're doing well.
Welcome back, Phil. Love to get into this deep dive with you. We got some really kind of important things to go over.
I'm excited to be here. Thank you for the opportunity. You guys are a great combination and a great show. So thank you for having me on.
Thank you. And the last time you were on, I missed the show, so you sat in for me, and I heard you two had a great time without me, so I wasn't going to miss it tonight. And you heard our open, so it's a smorgasbord. I'll let you start anywhere you want on the
Okay.
comments that Dominick and I just had.
Let's start with the BLS number. You were both very concerned about the number. I don't find it to be terribly concerning. So I know that might surprise you. And there's a reason why. So you have to be you have to understand how surveys work. This was a preliminary number, and it's based on assumptions made in a series of surveys. The problem with the survey system in the United States, and this is not a new thing, this goes back the better part of really, the problem started 30 years ago and has accelerated every single year. The way a survey works is if you run a business based on your relationship with the IRS or being part of a committee, you're sent a physical paper document. It's not an online system. You go through and write into the document the jobs you're looking for, the people you have, who you've laid off, who you've kept. That's part of the survey. They also check IRS records and they check unemployment rolls with the federal government. My summary is we used to get 70% of the surveys were back in on time. Guess what the number is today, just for fun? And going back
10.
30. So it's down, you've cut it in half. So one, the data is somewhat unreliable. But that doesn't answer the question why I'm not too concerned about it. When you look at the equilibrium in the U.S. economy, the number, and you look at the birth rate versus the death rate, when you look at, which basically means how many people do we have employed today to sustain, or how many people do we have employed to grow the U.S. economy. And that number historically has been around 100,000 people have been needed to, on a monthly basis, to be able to sustain the U.S. economy. So if you look at the BLS number, on average, going back, and really remember this number is from March of this year back to the previous March. So we're already 5 months removed from that. That's how old this data is. And to make it even worse, the official BLS number doesn't come out till February of 26 for March of 25, to tell you how long the government takes, to the point Dominick made how archaic the system is. The reality is why the market hasn't been upset about it and why the unemployment rate isn't gone higher. And I do think the U6 unemployment rate, which counts for everybody, those unemployed, underemployed, and no longer working, has told us that we are still far below the historical average unemployment in the United States. And the number per month that we need to create equilibrium between the birth and death rate probably is no longer 100,000. And the reason why is because of technology. And whether it's AI or all the other types of technology that have been going on for years. AI is just the newest wrinkle that has made the workforce more productive. So in that sense, I'm not overly concerned about the number because it's not a negative number, a consistent negative number on average going back. So the ultimate answer to the question is you have some of the best unemployment numbers of your lifetime. So I know the number may be weaker than we were. We were at 3.7 at one point a year and a half ago. And being at 4.2 today is still 1.8% better than what we grew up with. And you're still adding around now on average 70,000 a month. Where the breakdown comes, if we start to see a trend in unemployment, not employment, that's a different narrative. Meaning, do we start to see people who lost their job not retain their job? So there's something we keep a very close eye on. We look at weekly jobless claims, which is a much more accurate number because it's measured by unemployment rolls, people asking for benefits from the federal government. And we look at continuing claims, people who are continuing to get money from the federal government. And that goes on for 6 months, depending on the state they live in. So those numbers are much more accurate. And what they tell us is that we're still in this bandwidth around 230,000 people per month losing their job and applying for benefits, and then ongoing around 1.9 million. Here's where the alarm bell goes off. If the weekly jobless claims accelerate to above 260,000, we have a real problem. If weekly jobless continuing claims accelerate above 2.1 million, we have a real problem. So the answer is the backward-looking data doesn't concern me because we've been adding enough people. The current data suggests we're okay, but ultimately Dominick's right. Ideally, there'd be a revolutionary system put in place that uses technology that could be encrypted that would allow us to get much faster, much cleaner data because we do all rely on it. But let's not forget the one dirty word I'm going to leave you all with your listeners today. I'm going to give you a very dirty word. And it's a dirty word. You're going to hate this word, and it's going to reverberate in your brain for a long time to come, I think, as I hope. I'm going to give you the word normal. What are you seeing in the labor market? This is normal. This is pre-2008 normalcy. The inflation rate, normal. At 3%, actually 1% below normal. We grew up with 4%. Now we're at 3. That's a pretty good number. Interest rates, normal. Stock market returns of 10%, normal. So what we don't like is going back to normal from these exuberant markets that we've had really since 2008. And this overabundance of wealth that was created, so much so because the federal government pumped in so much money and ballooned our deficit, not totally a part of it. So the process of lack of federal stimulus, lack of extra spending is now creating normalcy. And no one seems to like it except the market. So,
Well,
and I'll
Phil,
tell you
Phil,
why.
one quick question because it ties into this question of the data, right? And I know you've spoken about this quite a bit in the past. We had a enormous, ginormous influx of immigrants into this country, tens of thousands, millions, depending on who you listen to, skewed all of the job numbers, skewed all of the job creation numbers, the available jobs. Now you're seeing the import of these laborers, we'll say dead stop, and maybe the export of some of these immigrants out of the country. All of this data, I don't know what normal means anymore. So whether we're looking at data that comes in weekly, monthly, annually, whether we're looking at job creation, hasn't all this data been skewed by just the immigration problem that we've lived through the last 4, 5, 6 years?
Except there's a shadow immigration market. How much of that, how many of those folks are not even on the payroll? And if they are on the payroll, they're actually included in the data using fake literature. The irony is they pay into Social Security and will never get that Social Security money. They're paying the taxes and never reap the benefit of it. But to your point, you did have this large influx of people, and we don't really know how much that affected the data other than to say we know the number's around 12 million. In fact, if you look at every single president going back to President Clinton, they added around 300,000 illegal or undocumented workers a month. And then their term total was about 1.2 aggregate for each president, every single one, by the way. And then unfortunately, President Biden, it ballooned to 12 million. Where those extra 12 million went is a bit unknown as of right now. That's not because either whether they're in the shadow market, undocumented, or documented illegally, they were part of those large payrolls. But let's not forget what happened during the pandemic. We would be in a catastrophic demographic situation if it wasn't for those people. What happened in the pandemic? We lost 4 million people to death. We lost another almost 10 million people to early retirement. So because we needed to supplant those bodies, and it's not a one-for-one system. It's not like somebody retires and we just slide in an undocumented person. But they did help make up for that gap. If you look at other countries' GDP growth post-pandemic, and you look at other countries' demographics, none of them have recovered back to the same GDP they were pre-pandemic. None of them, including China. And then go one further, all of them have much worse demographics than ours. So while I'm a pro-immigrant person, my mom and dad were from Italy, like Tom, certainly that we should have a legal process to get people here. Those undocumented workers actually became and filled a need that the workforce needed. Now that we're at an equilibrium again, I would argue going back to normal again, I think will be a sustained system. And then to your point, Dom, you're spot on. 2025 may be the first year ever in the United States that our population shrinks. Where there is we were flat during the pandemic, but we may actually shrink because we're bringing in less legal immigrants, which hopefully the administration can wrap their head around bringing in 1.5 to 2 million people a year because it's one of the four pillars of American capitalism and one that we have to have to continue to be successful.
Phil, I just want to go back to those two numbers you threw out because they're very specific. You said at 260,000 or above, new jobless claims and 2.1 million continuous, we have a problem. So as I said, those are very specific numbers. What's the significance of those exact numbers?
You're breaking trend. The annual trend over the last 5 years is at or far below that. If you go back to 2019, that's exactly where we were for both those numbers. So that's your demographic trend in there. That's why it's so terribly important. But go one further. What we haven't really seen is this sort of pressure in the unemployment market because up until now, for every person looking for a job, assuming the data is right, the JOLT survey, which measures the number of open jobs, has even less people, less companies responding than the unemployment number. But let's assume the number's mostly right. For the first time since post-pandemic, the number of people looking for a job and number of jobs open match. So now we're really at an inflection point. We had more open jobs, we had people looking. So if that inflection point is real, and I'm assuming it is, 'cause I can only go by what's put in front of me, then the breakage in those two data points tell us the unemployment market is starting to pick up, and now we have a real situation where higher prices paid because of tariffs or cost of goods in interest rates have now put pressure on earnings, which would then result to a weakened labor market. I do not think it happens, by the way, but that would be the scenario why it would play out. And that would be classic stagflation, which we can get to later, but that would be your first hint of a stagflation environment, which would be a poison pill to the United States.
But that's exactly the rock and a hard place the Fed finds themselves, right, Phil? We have
Right on.
inflation that we're already starting to see, and we can point the finger at tariffs, other things, but you're starting to see some on a monthly basis, some embedded inflationary pressure. I know we have the offset with energy and the cost of labor, but deep down in the dive, we're starting to see some inflationary pressure come through, and now we're starting to see the tick up and possibly unemployment or lack of job creation. So what do they do? What do they focus on?
So Dom, again, spot on. When you look at where we're at in the ISM services, and for those folks listening to know what that is, we measure the U.S. economy in two primary drivers. What we make, and we still make stuff. Our number one product is agriculture. I bet you couldn't guess what our number two product is, manufacturing, and what we manufacture. The second biggest thing we manufacture is education. But after that, there are some physical goods. So what we still make, which is 11% of the U.S. economy, and then the rest of it is 70% is services. Now, in between is government spending. So that service sector we measure called something called ISM services. And we have a range of 40 to 60. Anything above 50, we're in expansion. Anything below 50, we're in contraction. And right now it's at 52. Why this is relevant, in that services number, we measure prices. And specifically, so if you go to a restaurant and it costs you more at a restaurant, or you're paying the waiter or waitress more, that's included in that number. So if you think about it, what has been really expensive in your life? Everything really, but especially things like food and clothing and things around that. A lot of that gets rolled up in that service number because it's imported or stuff that's being made from our agricultural sector. My point is, to Dom's point, ISM services paid are up the last 3 months in a row, and it's the highest acceleration since October of 2020. So if we get a scenario, and again, I don't think we do this because tariffs, in my opinion, are a one-time price increase on a certain set of goods. It's not inflationary. But if we get inflation back above 3 and we find out tomorrow what that number is, I don't love CPI, which is coming out tomorrow. I care more about PCE, which is at 3 for core. We can get into that mumbo jumbo financial alphabet soup later if you like. But let's just say the stuff we buy every day is right about 3%. And you see the unemployment market weakening a bit. That's called stagflation. I mean, we are stagnant in growth, but we're still having inflation. Growth would be we're losing jobs, so we're stagnant or even getting worse, deflating to a degree. But more importantly, prices are starting to go back higher. Here's the one thing that I have to fall back on. This is minutia. This is a little bit of data. This is not half of 1% or 1% or acceleratory data that is so bad that we have a real problem. This is minor movements in the data, which is part of being in a normal environment. In a normal environment, this is what happens, ebb and flow. Where I think the Fed is in a rock and a hard place, I think their 2% mandate is not necessary. That became out of the Austrian School of Economics, to some degree, what happened overseas. More importantly, what the belief is for the folks who make less than $100,000 a year, what would be less punishing on them, is where that number comes from. But yet we all grew up at 4% from 1980 to 2000. We were very comfortable with that number. The economy did just fine. So at 3%, I think we're just fine. I think that's what you're going to find when you get to a new Fed chair. The 3% is just fine. They lower the front end of the yield curve to 3%, and we go from there. But to your point, Dom, they're right now, the perception is a rock and a hard place. I don't think they're in a rock and a hard place. I think they're going to methodically, slowly cut because of a weakened labor market.
So to that point, Phil, we've been doing this a long time, and one of the reasons I love talking to you is you're never an alarmist. You're always very logical. That's why you're so good on television.
Thank you.
So, would you agree that the economy is weakening, but the wheels are not falling off? Would that be a fair analysis?
Yeah, absolutely. Because on one hand, you're paying 30 to 40 cents less per gallon of gasoline, depending on where you live. So that's a big win. Your food prices have leveled off. They're never going back to where they were in 2000. You're 50% higher on food costs. But here's a fun little secret. If I asked you guys out of the last 10 years, how many of those years did wages beat the rate of inflation on an annualized basis? If you had to guess, I know you both will get this right, it's eight. So 8 out of the last 10 years, wages are higher than the rate of inflation. What the average median salary in the United States today is $71,000. The mean is $66,000. So we saw wages push up and accelerate the average person's income today. And what does that mean? They're hanging on. They're hanging on even with this higher level of inflation. So to your point, Mike, it's going back to normal is it's okay. So besides the fact that they're getting a little bit of a break on gasoline and they're living with the price of food, they're making enough money to sustain themselves. And that's why we don't see runaway credit card debt. It's a bit higher, but those defaults are not as serious. Auto loans a bit higher, but not in serious default. Even student loan debt, which has come back on, is right back to where student loan debt was pre-pandemic from a default standpoint. So we're seeing the U.S. consumer just hang on. So what does that mean, Mike? The wheels are not falling off. But we're going back to normal. Normal means 2% GDP growth, means 3% inflation, a stock market that gives you 8 or 9, a bond market that gives you 4, and it's boring as all hell. Why?
We'll
Because
take it.
you don't get a, yeah, you're right. We don't get a lot of stimulus. We don't get a lot of the artificial stuff that created all this wonkiness of over the last 10 years, 15 years.
So under the category of, and I'm going to literally pick up where Mike left off, the wheels aren't falling off the bus. I know we're struggling with this idea of inflation, but for over a decade, we couldn't even get to 2% inflation. And that's efficiency and technology. Isn't that the future, Phil? Isn't that once we get past this cycle that American innovation and technology and cutting edge will reinvigorate the economy and bring inflation way back down?
I have a fun stat for you. The average Chinese worker produces $15,000 a year in productivity. The average American worker, which we're the most AI advanced country in the world today, the most data centers by far 2 to 1 versus the rest of the world. Most usage at corporations, even though they're not using a lot to use it, our average productivity per year per worker is 145,000. If you look at the last 26 months of productivity, it's up every one except for one. Look at last month's productivity, crushed it. So you're spot on. Why do we succeed? Because we have the most diversified economy on the planet. We're a service-based economy, the default currency, the wealthiest in the world, and we still make some stuff, and the services that we provide are utilized in a variety of different places and around the globe and in our country. And that way it's very self-sustaining. So to your point, Tom, I don't think the inflation issue is a big issue anymore. I don't know why it's being made such a big issue. I think lowering interest rates methodically and carefully to not spur higher inflation will be a boon for the small cap company and for the average consumer out there who makes 71 grand a year, who's got undue pressure on them. We haven't seen a spike in inflation. We should be accepting 3% and cut rates not down to 2, because that would be ridiculous, but certainly back down to 2.5 or 3 on the front end of the curve. I think 3 is the right number. So, I mean, I would totally agree with you. When I think we lose sight of, look what U.S. companies have done in earnings in the last 10 years, last 3 years, last 1 year, last quarter. And I'll take out the Mag 7 because the rest of the world doesn't have it. And sometimes we forget how powerful capitalism can be, our ability to re-innovate. You didn't even know the name NVIDIA 5 years ago. And look what it is today, the biggest company in the world. So when you think about our ability to reinvigorate our economy through this incredible system of capitalism, well, in that sense, I think you got to give credit to the other 493, which, by the way, are going to have 5 to 6% earnings growth, maybe as high as 8 when all said and done for the second quarter. And the Mag 7 are probably going to do 10, 11, low 11 it looks at this point. And what does that mean? The margins on the Mag 7 are 30. Average margins are 8. How much money they put in their pocket versus the regular companies doing about 8. Why is the stock market up? Because of that. Now, stock
They're
market.
making money. The companies are actually making money.
That's it. Now they're not cheap, and we should get into that. The stock market is not cheap, and that's why I believe in a diversified portfolio, taking profits. We should talk about what not cheap means. But it's certainly not some catastrophic situation where the wheels are falling off. We're heading into some massive recession. That only happens if the Fed really screws up and if there is real leakage in the unemployment market so bad that this number is the canary in the coal mine that we talked about earlier, and on all these surveys are totally wrong, and we're rapidly racking up unemployment, but that just doesn't seem to be the case.
Phil, let's stop right there and take a break. And when we come back, let's talk about the two things you mentioned. One, what the Feds might do with interest rates next week, and two, you touched upon it, why the market has been going up and why you think, that's not overly concerning, that there's some validation for that. So let's take a break right there, and we'll be right back with Phil Blancato, the president and CEO of Ladenburg Asset Management. All right, I'm Michael Hartzman, back with Dominick Tavella for our final segment with Phil Blancato, President and CEO of Ladenburg Asset Management. So, Phil, you alluded to it before the break. And Dom said it on the open. It's kind of a fait accompli that they're going to lower interest rates. The expectation prior to some of these numbers weakening was 25 basis points. Now the concern will be if they do 50 basis points, is that kind of an uh-oh moment? Did they wait too long? Is there something they're not telling us? So, yeah, I know you have a crystal ball somewhere in that office. What do you think they do, and how do you think it'll be interpreted?
Let's see what happens tomorrow. In fairness, give me and let's assume tomorrow we get relatively benign inflation headline. It's going to come in probably 2.6, and then core, which excludes food and energy, and we do that so it's more consistent number because food and energy can be very volatile depending on the time of year. Seasonality matters. Assuming the headline number will be 2.6 and the core number will be something like 2.8. then the Fed has everything they need to just cut a quarter of 1%. Here's where it gets really messy. If by some chance the headline number comes in at 3, and I don't think it does because gasoline's been lower and food has not accelerated, egg prices are back down to normal. But if by some chance the headline number goes higher because of the other components of it, or more importantly, the core number breaks above 3, and the Fed is concerned that tariffs are creating inflation, and they have to look at which one they'd rather deal with more so, inflation going back higher or a somewhat weakening labor market, that's going to create tremendous turmoil in the markets. So if the number comes out higher tomorrow, the threat of the Fed not cutting, which has been a tailwind, a help for the market, will one create volatility. The second scenario, let's say tomorrow is benign, but we get additional labor data, which we will. We'll get some more labor data between now and next week. My minutia stuff about in the manufacturing areas. But let's assume that they panic and they thought that the last round of data, and especially today's data on the 1 year look back, is so extreme that they cut half of 1%. The market's not going to go well with that. That's too much of a cut. And remember, the market's it's this finicky beast that September is the worst month of the year. It has been. It's the only month of the year that's negative going back 100 years. It's on average anywhere from 2 to 5%, with an average of 1.9 predominantly, but has been as low as 5 to 10 some months. May is the other bad month. March is never a great month. August can be volatile the second 2 weeks of it, but September's the worst. So think about this culmination of events. If the Fed cuts because of interest rates, inflation, I'm sorry, if Fed cuts because they're worried about the unemployment market and they go half of 1%, that's very problematic. I think the market won't like that. If the Fed doesn't cut because inflation comes in higher than expected, then the market's certainly not going to like that. More than likely, what happens, crystal ball and all, is that they'll cut a quarter of 1%, and at that point they're going to say more than likely we're going to begin the process of moderating interest rates because we're concerned about some of the pressure on the labor market. And I think that's where they'll come out of this. And that's part of the reason, I would say 25% of the reason why the market has sustained this, call it up 10% on the year, because the expectations are there. And it's really why the bond market has rallied down, lower interest rates, lower yields on bonds. There's some other reasons too. We can get into that, but it's also more important why small cap stocks have had a real nice run here in the last 6 weeks, the number one asset class, because the expectations are interest rate sensitive stocks, which are trying to be your companies that pay big dividends or value stocks, and then smaller companies that need to borrow money will do better in a lower interest rate environment.
So, Phil, it might put you on the spot. I'm going to do it as well. We've been saying all along to our clients, expect some pretty good volatility here for all the reasons you just rattled off. But we would see the volatility as a buying opportunity. Yes, no, maybe.
Yeah, I mean, at the end of the day, for example, the French bond market is a mess right now. Why? Because the French are now have 6% of their GDP goes to debt servicing. We're not even that bad. We're not even close to that, actually. Now, or ours is a fraction of that. You look at what's happening in the UK, very similar. You look at European growth, it's flat. Germany hasn't grown since 2017. They're up 20%, 22%, and the US is only up 10. Why? Well, the dollar devalued by 10% is why international lifted off. So when you look at the US market, it's healthy from an earnings standpoint. It's healthy from a growing US economy, unlike Europe. Our problem is valuations. When you look at the price of companies in the S&P 500 and you just divide them by how much they make, that ratio, we call it the PE ratio. And that ratio, we look at historical averages. And if you take out this blip of time in the last 10 years, that historical average is 16 on the S&P 500. We lived with the last 10 years being at 18 because there's been so much money pumped into the system. And guess what it is today? 24. What is it without the Mag 7 in it? 22. So stocks are priced to perfection. They're priced as if every single quarter we're going to get phenomenal earnings growth. That's asking a lot. So I don't disagree if we get a sell-off in the market. And I think they're healthy. Remember, everybody, we get 3 corrections of 5% every single year. We get one of 10% just about every single year, and usually one of 15 to 20 about every 3 years. And we did have one. Everyone forgot. Remember back in February,
April. Yeah,
April,
April of
May,
this year.
we had a
Hello.
pretty rough buying moment. I don't think we're looking at that again because this isn't this Liberation Day stuff that happened. But certainly the idea of selling off because of the Fed being too aggressive or not aggressive enough, higher inflation or modest inflation, weaker unemployment, all these kind of concerns would tell me a mild sell-off 5 to 8%, get us back to zero on the year on the S&P 500. I would you'd see it as a buying opportunity for sure, especially in other things than the Mag 7.
Bill, let's switch gears for a second and talk about international. You mentioned the dollar is weakening. Um, Treasury sales by foreign entities is down significantly this year. And last week there was a picture of the I don't know if it's a president or whoever Modi's title is. He's with Xi in China. And without this being a political comment, it looked like the prior administration was trying to cozy up to India, one of the largest economies in the world. And for some reason, this administration seems to be trying to alienate India. So, number one, internationally, are you as bullish as what appears to be the rest of the economists are? And two, do you see a problem with us trying to alienate one of the largest economies in the world, which up until now we had a fairly decent relationship with?
Really good question, Mike. So the first question, as far as international, I'm not as bullish as everybody else. We haven't had an allocation to international in over 10 years. And in fairness, this year our model portfolios are slightly behind because we do not have that allocation. We would have probably a full point if we did. Even a 5% allocation would have given us that. But our belief is that it was a trade, not a trend. And the reason why it was a trade, let's just give the example of a grocery store. When you walk in the grocery store, you have the middle shelf, which are your moderate price items and probably the most popular, and I'll call those most of US stocks. The top shelf is the most price expensive item, but it's the one everybody wants. So they look up, and that's your Magnificent Seven. And on the bottom shelf was the cheap ones that are on sale, and that was International. International hasn't had earnings growth of greater than 0 to 4% at any point in the last 15 years. But back to that PE ratio, the price of companies divided by how much they earn, it was only 14, and their average was 16, just like ours. So they were 2% below their average, where we're 8% above ours. And that's why International had a great run. That was part of it. They were really, really cheap. And then when the US dollar, because of Liberation Day, began to weaken with the concern that the US economy would struggle with tariffs, and so far we're not sure. Remember, first quarter GDP was negative. Second quarter was through the roof because of this weird import-export thing. This quarter is probably going to be 2%. So it seems like we're okay. Again, just doing fine, nothing special. So that really hasn't happened. But yet the dollar hasn't weakened yet, hasn't strengthened yet. Excuse me. The reason why? We got too much damn debt. At the end of the day, the United States has too much debt. We cannot get our fiscal house in order, and tariffs aren't going to fix this problem. You've got an issue with Social Security, Medicaid, Medicare, and interest rate payments on your debt require us to spend more than we make per year. So that reason the dollar weakened, and it should have. That's why gold is through the roof. It's why Bitcoin is through the roof. These alternative currencies that have a limited quantity, whereas the U.S. does not. But to answer your question, I do think international is becoming interesting. Why? Because they finally have opening up the spigot on debt, that they're willing to spend about a $500 billion to $1 trillion in defense. Germany hasn't bought a new tank in 30 years. They haven't spent any money in defense whatsoever. The problem is they're in debt up to their eyeballs. So I think selective entrance into the European market, especially if we get some sort of minor sell-off there, would be interesting to me. And I do it with dividend-paying stocks. So you gotta get paid to wait that out. Why? Because their valuations are better than ours. The second part of your question, the India, China, Russia trio, that culmination, I think is all a threat to try and push up against the United States. Here's the dirty secret nobody ever wants to admit. You can take India's economy, China's economy, and Russia's economy, put them all together, and they still don't equal the United States, not even close. India needs us a hell of a lot more than we need them. China's exports today, they're down. They're down from about 30% to about 16 to 18% of their exports come to the United States. We get a lot of stuff from Mexico and Canada. That's our number one and number two importer. But the problem with China is a lot of countries in the world are kind of in the same boat, where the whole world decided, especially Europe and us, uplifted our middle class and sent it to China 30 years ago and basically hollowed out every economy. Look at the European economy. They haven't grown in over 20 years. So this idea that China's going to come to the rescue of any nation, I think is kind of silly. Does the three of them teaming up worry me? It doesn't. Not even from a military standpoint, because nobody wins in that. I think she knows that. But your question about India, that one, we're using a power play by them not allowing them to buy Russian oil to force Russia to the bargaining table to end the Ukraine war, and I just don't think it works. So I'm a apolitical person. I think the president made a mistake on this one. I think him alienating India is a mistake because at the end of the day, much of your medical supply chain was made in China and is shifting to India. Some of it could shift and will shift to the United States. But that's where the tariff legislation, what happens here with the Supreme Court, that's where I do think the big, beautiful bill had a very interesting component to it where you're allowed to immediately deduct from your revenue any expenditures that you have, which will spur manufacturing to some degree. But at the end of the day, having a friendly relationship with India, who has the biggest population on the planet and lots of manufacturing prowess for things that we need and we don't want it from China, who, let's just be honest, doesn't want to play nice with us, I think is a terrible mistake. That's a mistake one the administration made, and the other profound mistake they've made, which is somewhat related to India and China, is the de minimis $800 exemption was a mistake. I don't understand why the president went there. I couldn't disagree with him more on that. All you're doing by tariffing goods under $800 is putting tremendous pressure on small businesses, which are the lifeline of the U.S. economy. 80% of the U.S. workforce, 80% are employed by businesses of less than 250 people. Why would he go there? There's no reason to do that. That's not going to help you military standpoint, economic. It's not going to generate enough revenue. It's just another thing to throw into the pile for negotiation. And look, I care about the economics. I'm not picking sides. I don't care about elections. They, in my opinion, they both spend too much and don't focus on the facts. But in this one, I think that was a misstep on India and on the de minimis exemption.
So, Mike, if you don't mind, perfect excuse to bring up small cap stocks. We introduced them into our portfolio and kind of suffering all year long, except all of a sudden we don't look so dumb. I know you brought them into your portfolio.
Yep. We look dumb.
I'll let me look dumb and let you look smart, but all of a sudden, not so dumb, Phil. We've had a really good run here, small and mid cap stocks. So I'd love for you to tell me it's going to continue, what allows it to continue, what allows the rails to come off the bus here and the train and derail. So what do you think going forward?
So you look at earnings growth of small cap stocks in 2024. The average historical earnings growth of small cap stocks is about 10%. In 2024, it was almost 12, which is why we got excited about it and why we introduced them, especially because back to that PE ratio, we care what it's like. It's, PE ratio is basically, I want value for my money. I want to buy things that are not expensive. I don't want to buy the most hottest car on the street. I want to buy one that's going to get me the best mileage and be a fair price. And that's what small caps represented us. Earnings growth for this year is going to be almost 25%. And earnings growth for next year, assuming we get interest rates back to around 3.25, could be as much as 40%. So now you get into this exceptional earnings growth and you're buying it cheap. So that's why we like them. And it's very consumer centric and it's very dependent on lower interest rates. So in a normal US economy, despite the de minimis exemption, because not everything a small cap company makes is imported, it's going to have an impact, but not completely. I think more on the consumer and less on the company. Assuming we get through that piece of it and hopefully gets reversed, but we'll see. And an environment where we begin to lower interest rates methodically, your winner in 2026 at the end of 25, and it has been in the third quarter, is small cap stocks. What derails that is a recession. There are some black swans out there, and one of them would be a recession and the things that would cause a recession. In a recessive environment, small caps will just get clobbered. Why? Because what happens in a small cap environment, you find that people tend to shop at the Costco's of the world where they can get the best bang for their money and not at their local mom and pop store.
Phil, we got 4 minutes to go. And about 5 minutes ago, I said before, you're not an alarmist. I can't end the show with you talking about a recession. So what are you enthusiastic about for the last quarter of the year?
I think that, let's not forget the fourth quarter of the year is the best quarter of the year. The turnaround week is always that second week of October generally. So far, September has been quite quiet. We haven't seen anything of real concern yet. We still got some news to go with the Fed here. Ultimately, the U.S. economy is just simply slowing down and going back to normal. So what has me enthusiastic is everything but the Magnificent Seven. I think the opportunity to diversify into things like mid-cap and small-cap stocks we've talked about, but I'll go really boring for you. I love the bond market. You know what the bond market might give us this year? A whopping 8% rate of return if things go the way I expect them to go. We're already up 5 on the year. Why not get 8%? And by the way, I'd argue you have a generational opportunity in municipal bonds. We live in the state of New York. This is a really expensive place to live. You know, the average effective tax rate if you live in New York City when you pay federal, state, local, and city tax is over 50%. Yet I can go buy a New York State general obligation bond at a 5% yield, which gives me a real return of 8%. My gosh, that's a pretty incredible number. By the way, I have no risk in it, a 10-year guarantee, get paid every single month, and go out and start shopping for holiday season. So I think we sometimes get so caught up in, I got to own the best, greatest stock that's going to quadruple, quintuple, whatever. Well, guess what, everybody? That's not normal. NVIDIA is a great name today, but we know a lot of great names that are gone. Remember things like, GE had to completely restart and go bankrupt. GM restart and go bankrupt. IBM hasn't made money for a year. We can go on and on and on. We want to talk tech companies. We can talk tech companies. Microsoft didn't make money for 25 years, 20 years. It was dormant. And it's the last 10 that finally turned around. You made no money. Go buy UPS. Stock's a bust. People own UPS forever because it's, God, I don't know, I worked there. So we fall in love with these names. My best advice is the market doesn't love you. Don't love it. Look for those opportunities beyond the Mag 7. Go into small caps. Maybe buy a good bond. Be diversified because it limits your risk and it gives you the opportunity to own other things, which I think offer better long-term value.
Bill, I just want to jump on that because you're coming right out of the Rick Reeder, BlackRock school. Love bonds. And again, a couple of months ago, it didn't look so smart having those in the portfolio. But with the 10-year treasury falling now to 4 handle from 4.7, I think, at the high this year, these bonds look terrific. And there's still a lot of value there over the next 12 to 18 months.
Yeah, if you're in a money market today, you're going to watch your money market yields go down and down and down. Why not do this? Rotate from your 4% money market to a 4% bond and you lock it for 10 years rather than watch it go down. Real simple math. It's all different. If you go to your bank, local bank, and buy CDs, good for you. Well, the yield you get today is not going to be the same yield a year from now. It's going to be down by probably 1.5%. So rather than miss out on the opportunity, go buy some real bonds. And there's nothing wrong with owning real bonds that are going to take care of your portfolio for a long time to come. It's boring. It's not exciting, but that's why we want some balance. We talked about small caps. What a wonderful opportunity. Take some profits. It's okay to pay the federal government. I promise you. If you made $100 on a trade, you're only going to lose 20, but you still made 80. Go and buy something else and maybe make that 80 into another 180. So I think it's just sometimes we get so caught up in the minutia, we lose sight of the opportunity. And I think that's where a lot of folks are today.
Phil, we're going to have to end it right there. Thank you so much for making the time and staying late in New York City this evening. We always appreciate your insight.
Thank you. I appreciate the
Well,
opportunity.
I wish time allowed to continue the conversation and have you back more often. We'll just grab you whenever we can. And again, very much appreciate you taking the time.
My pleasure. Thanks for having me on. It's an honor.
Thank you. And have a great night, everyone. And we'll see you again next week on the Ladenburg Report.